Hey there, business owners. Let's dive into how macroeconomic variables like GDP, inflation, unemployment, and interest rates impact your business performance. Understanding these factors can help you make smarter decisions and strategize more effectively. First up, gross domestic product or GDP. GDP measures the total value of goods and services produced in a country over a specific period. Think of it as a broad indicator of economic health. A growing GDP means a healthy economy with increasing consumer spending, which is great news for businesses. More disposable income usually means higher demand for your products or services. On the flip side, a declining GDP indicates economic contraction. This can lead to reduced demand, forcing you to cut costs or even downsize. Take the 2008 financial crisis for example. The US GDP contracted, leading to a severe recession. Companies like General Motors and Chrysler saw significant drops in sales and needed government bailouts to survive. Next, let's talk about inflation. Inflation is the rate at which the general level of prices for goods and services rises, decreasing purchasing power. Moderate inflation is typical in a growing economy, but high inflation can erode the value of money. For businesses, inflation can have mixed effects. On one hand, you might pass on higher costs to consumers through price increases, maintaining profit margins. But if inflation rises too quickly, it can reduce consumer purchasing power, leading to lower demand. Additionally, rising input costs can squeeze your profit margins. Remember the late 1970s in the US? High inflation and stagnant economic growth coexisted, known as stagflation. Companies struggled with rising costs for raw materials and labor, while consumers cut back on spending, leading to declining profits. Lastly, let's discuss interest rates. Set by central banks, interest rates influence the cost of borrowing money. Lower interest rates make borrowing cheaper, encouraging investment and spending. Higher rates make borrowing more expensive, slowing down economic activity. When interest rates are low, you're more likely to borrow money to invest in expansion, new projects, or capital expenditures. This can lead to growth and increased profitability. Conversely, high interest rates can increase the cost of existing debt and reduce the likelihood of taking on new loans, potentially stifling growth. In conclusion, interpreting macroeconomic variables like GDP, inflation, unemployment, and interest rates is crucial for businesses to navigate the complex economic environment. By understanding these factors, you can anticipate changes in demand, manage costs, and make strategic decisions to enhance your performance in both favorable and challenging economic conditions. Thanks for tuning in, and stay